What is the easiest way of all to build wealth in the stock market? That is through index investing. Index investing has become more and more popular and will continue to be popular because it is so easy to do, and it almost guarantees that you will build long-term wealth. The only fund that you need to build wealth in the stock market, I would consider that VTI. That is the Vanguard Total Stock Market Index Fund. This is an exchange traded fund that you can trade on the market. It has a market price. You can just open your brokerage account and purchase into this fund. You can purchase shares or you can purchase fractional shares, so that means a dollar amount. VTI is simply a basket of stocks of the entire stock market. So in essence, you are betting that in 10 years, 20 years, 30 years from today, the stock market, the US economy, country is going to be bigger and have more businesses and do better than it has done today. So this year, of course, Rona has happened and the stock market has gone way down, but that's just one single year out of decades. So from 2008, during the Great Recession, the stock market doubled in value, tripled in value. You could be buying in that entire time, even if you just did a tiny amount of money. You did $10 every week, $10 every month. Think of how much you could have over 10 years if that money compounds at 7, 8, 9% a year. What are the advantages of owning VTI? There are several advantages to owning an index fund. Let's go with the first one. Number one is that it's very easy to buy into. It's very easy to use, sell, do whatever you want. So you can take shares or you can take dollars and you can invest those into the VTI index fund. Now, there is also, Vanguard also offers another fund called VTSAX, which has been made very popular by the FIRE community. And that is the Admiral shares, the more advanced institutional shares of the total stock market index. But I actually like VTI more than VTSAX just because it's traded on the market. You can trade in and out in an exchange traded fund, and I believe it's lower cost. It has lower expenses than the other institutional shares. And for investing purposes and for the individual investor, I think VTI is the way to go. So number two, what's the second advantage? The next one is that you are diversified. So your money is not in just one single stock. It's in stocks in the entire market. So you might own a tiny piece of Apple, you might own a tiny piece of Amazon, you might own a tiny piece of Walmart, ExxonMobil, what else? Restoration Hardware, Tesla. Now it is weighted, so the S&P 500, the largest stocks in the country, are given more priority in the fund than the smaller cap stock, maybe under $1 billion or maybe only worth 500 million. Stocks like that are given less treatment than the big boys like Apple, Walmart, Microsoft, those guys. You own everything. You own all these different companies. I can't remember exactly at the last count how many are actually in the fund, but there's a lot. So you're not relying on just one company to do well. You're relying on the entire market, the entire US economy doing better tomorrow than it's going to do today. And it will always, even if the market doesn't grow, let's say for 10 years that it stayed flat, that it didn't increase the way that you wanted to, but it stayed flat. You're still invested in those stocks, and those stocks still earn dividends. Many of those stocks earn dividends. You could still be increasing your position by being invested in that fund just by holding stocks. There's two ways, this goes to the next advantage. There's two ways to earn gains from investing in the stock market. And you know what they are. So the first one is capital gains. You buy a stock for $100 and it goes up to $200. You just made $100. That's capital gains. But the other way is through dividends. I love dividends. I feel like dividends are the secret sauce to the market, is that you own 10 shares of Apple at $1. You just made $10 from owning your shares. And that's every quarter. Apple pays out qualified dividends, which are taxed less than regular income. And they pay out every quarter. So 4 times a year you get that money just for owning the stock, for not doing anything but holding on to that stock and being invested in that business. Well, if you're invested in the VTI, you have a mix of companies that do both. Some companies don't pay any dividends, so that's the Berkshire Hathaways of the world, that's the Netflix, Amazon, Tesla. These companies want growth. They believe that their money is best invested in the growth of the business and the growth of the share price over time, versus companies like Walmart, ExxonMobil, British Petroleum, Chevron. All of these energy companies, utility companies are known for paying a steady, stable dividend, and then hopefully slowly increasing that dividend over time. Although, Rona has kind of destroyed some dividends. Wells Fargo has slashed their dividend. Lots of companies are cutting that back because the revenue's not there that once was. But a lot of these companies are just holding steady, like Apple, Microsoft. Some of them are even still increasing, even through a pandemic, their dividend payments. So there's a great, if you can go watch our video on the dividend aristocrats, companies that have paid a dividend, a stable dividend over time, and actually increased for the past 25 years. There's a list of companies that have done that. And so it's a good idea if you invest in those companies. They can actually do as well or better than their competitors. So just because they're paying out dividends and increasing doesn't mean that the stock price has to suffer. The stock price can still increase even while paying dividends. Let's get into the disadvantages of owning VTI. There are some disadvantages that you want to be aware of. And the first one is the double-edged sword, is that it's so easy to buy into, but you don't have control. It's easy to buy into, it's diversified, but you don't have any control of that. You don't get to choose what goes into the index fund, which is really probably a good thing, because the more you tinker with or try to improve your performance, probably the worse performance that you'll actually have in the market, versus if you just buy into something and then don't touch it, just leave it alone, it'll probably grow better over time. So with an index fund, with VTI, you don't have control. There is a manager at Vanguard or these other companies that also offer funds. They are the ones that manage the fund. They determine rebalancing, when to change from Apple, from 20% in Apple to 10% in Apple, and increase to Microsoft. They do all that for you. So it's managed by the company, by the operators of the fund. So you don't get any choice. You don't get to tell them, no, I don't want to invest in this, I want to invest in that. And it just owns everything. So volatility. Let's talk about volatility. Of course, everyone knows the stock market is volatile. It goes up, it goes down. Same with this index fund. The index fund goes up and it goes down. When there's a pandemic, it goes down. When there's a housing bubble crash, it goes down. But I argue that if you're invested in VTI, you should really be invested for the long term, for the next 20, 30 years. For the most part, the index fund is used for long-term investing. That's why these funds are really good for 401ks, 457s, any type of retirement, tax efficient fund. You don't want to have to manage something for 10 years and determine over 10 years, unless you love it, unless you're someone like me or Warren Buffett or something, that you actually enjoy reading about this stuff, this topic, then great, go for it. But if you're someone with a family, or like someone like my sister who's in the medical field, you don't want to be dealing with managing your portfolio and trying to be a doctor or trying to be a teacher. You just want to know that your money is taken care of and that it will grow over the long term. That's what makes the index fund so great. There are small fees. So again, this is an advantage and a disadvantage. So an index fund, because it's managed by someone else, there's fees associated with it. So one reason that I love Vanguard is because they're known for having really, really low fees. They have a strong reputation for low fees. They take care of of the owners of the business, the shareholders, that's you, and they're just really reliable and continue to find ways to cut costs and keep the funds available to everyone as low cost as possible. But that's also a drawback because there are fees versus where if you opened your account with M1 Finance. M1 Finance is the brokerage account that is personally my favorite. You can use whatever you want. You can use Robinhood, Schwab, Fidelity. There's a million of them out there. I just like M1 because of the software and the tools and the way that it's set up. So you get a pie and you choose, what you can choose percentages, and then it will put your money into your pie. Your 50% into stock one, 50% into stock two, and then over time it will just keep allocating your money as you continue to put money into your pie. An index fund does have fees versus if you bought a share of Apple or just an individual stock, Microsoft, Apple, Exxon, Walmart, there's no cost today. There used to be, historically in the past, there was a fee to buy and trade. So to buy and sell, you used to have to pay $5, $10, $25 just to buy into the stock. So that right off the bat, you either have to invest a lot of money in the beginning to make it worth your while, $25, or you have to believe that a stock is going to go up $25 or whatever the cost is of making the trade. So you buy in and then you need it just to break even. You have to have it increase $5, $10 to get your money back. So, but today that's not the case. You buy into a stock, it's free. You get free trades. So you buy a share of Apple, it doesn't cost you anything to purchase that share and to be an owner in that company. But if you own an index fund, you are going to pay a management fee per year. It could be very low, and I would argue that the low fee of an index fund is really the price of set it and forget it. The price of convenience. You're basically outsourcing from you to the business your management. So they're in charge of managing the fund and taking care of all that. Versus when you buy into a stock, it's all on you. Stock 1, 2, and 3, you have to buy into each stock and determine how much you want to do that. So you're doing it all yourself. You don't pay the fee, but you manage it. You manage your own portfolio. Or you can hire out to a portfolio manager or a money manager, and they are going to be a lot more expensive, have a lot higher fees than Vanguard's VTI, and that can really eat into your investment gains. So the last disadvantage of owning VTI is that you're invested in everything. You're invested in the entire market. So if you don't believe in owning oil and gas, you believe that climate change is real, it's happening, you don't want to be a part of that, you want to be part of the solution, which means maybe investing in alternative energy, wind, solar, water, things like that. Well, guess what? VTI is not for you because it's invested in oil and gas like Exxon, Chevron, Anadarko, Occidental, Devon. It's invested in all those oil and gas, all those energy companies, or there's all kinds of businesses out there that you might not want to be associated with. For instance, we just mentioned oil and gas. The next one is maybe mining. You don't believe in, there's lots of companies that are mining companies that go out and are trying to harvest gold or copper that, you might think that are harmful to the environment. Their practices are harmful to the environment. The other one is sin stocks. Sin stocks are cigarettes, tobacco, maybe marijuana, gambling. There's lots of, maybe you are morally against gambling, so you don't want to invest in Vegas or Caesars or Wynn or Las Vegas Sands. Those are all hotel and gaming stocks, and you feel like you don't want to be associated with that. So BTI is, even though it might be a tiny fraction of their portfolio, your portfolio in the fund, it's still there. You're still investing in those businesses. So and there's also the other one I was thinking about was maybe you believe there's lots of companies out there that are defense contractors. There's lots of them that are legit, like Lockheed Martin is right down the street from me. I live here in Dallas. You might not want to profit off of war. You might feel like investing in those types of businesses is profiting off of war, because we are still involved in many the United States is involved in many conflicts around the globe. So these businesses support the military and the military complex that we have here in the States. So you might feel like you don't want to be a part of that. You want to be more invested in the United Nations or peacekeeping or things like that. Well, you don't get to choose that, because VTI does it for you. They manage it for you. You're invested in the entire economy. That includes the good, the bad, the ugly. Let's take action. Now that you know about VTI, what are the next steps that you should do if you really want to build long-term wealth and grow that wealth over time through stock market investing? Now, before you even do this, I would determine what are your goals. Are you someone that wants to build wealth through the stock market, or do you want to do it some other way? There's other ways that it can be done. So number one, you could build your own business. You could start your own business. You could start your own YouTube channel. You could start your own restaurant and go. I would recommend, if you want to do that, put all your eggs in that basket. Go and save your money and go start a restaurant or start a YouTube channel or start that business that you want to start. The other way you can do it is real estate. I've started investing in this I purchased land and property, and eventually want to turn that into monthly rental income. Or go watch our video about defining your goals, and then come back, and if you've decided that you want to do stock market investing, download the M1 Finance app. I will put the link down below in the description, and open that account. You'll have two different options. You can do just a regular tax brokerage account where you invest in stocks, but that you will pay taxes on if you receive dividends, or if you sell stock long term, you'll pay taxes on that money. You can also open an IRA, an individual retirement account, and you can choose a traditional or you can choose a Roth. And you can go watch our video about the differences between those two. But I personally have both actually, but I'm now doing the traditional, because the more tax deferment you can get, the better, because there's ways to withdraw that money at lower tax rates or no tax rate. If you are invested in that and you strategize and you make a plan to withdraw that money at a later date. So go open your account. Next is to find VTI and just put a little bit of money. Put $10, $20, $100, whatever you feel comfortable with. Put your money into that fund and start being an investor. Why? Because it's better to be in the market than out of the market. We've already talked about dividends. They're so important. The longer you're in, the more dividends you'll get, the more gains you get. And let's be real, you're not going to be able to time the market unless you do this professionally. You're probably not going to be able to time the market, which means that buy low at the bottom and sell at the top. If you dollar cost average month to month to month to week, or weekly, every week buy into it, you'll buy shares at different prices and it will even out over time. Some of your shares will be older, will be lower cost, and then as your newer shares will be a little bit higher cost, but it doesn't really matter. You're still invested. Every time you put more money in, you're going to get more dividends. And then you can reinvest that money back into the stock. Once you have deposited and bought your VTI investment, then I want you to go over to the recurring investment section and schedule regular deposits into that account. You can schedule money to directly be moved into your account and to purchase the stock however often you want. I'm still an employee, so I get paid 24 times, 2 times a month, so that's 24 payments per year for 12 months. So every time I get a paycheck, portion of it goes right into my investment account. And then the beauty of that is, the reason you want to do that, and I would recommend starting really small. So whatever you feel comfortable with. If you feel comfortable with $5, great, do that. Because you want to see the magic start happening. Once you see it happening, that will give you more motivation to increase, to increase your deposits to that account. So maybe you start really young. Maybe if you're a little bit older and you're nearing retirement, you really need to crank up those deposits right now. But if you're a lot younger, you have 10, 20, 30 years, start very small and then increase over time. Number one, you'll adjust your spending so that you know what's in there, what's in your checking account. You'll have more of an idea over time, and then you also might get a raise. You might get a raise, or you might determine, you know what, I need to make more income. There's nothing better than making more income. You know, you can cut as much as you want, but the magic happens when you get more skills, you start your own business, you start a side hustle, and you bring in more and more revenue. Once you do that, that's when you start increasing. Once you start earning more revenue, once you start getting those raises, then you put more and more into your recurring deposits over time, and then before you know it, you'll wake up 20 years from now and you'll have a bucket of money. So now that you know everything about BTI and you're going to go invest in that, go watch my next video about dollar cost averaging and learn about why that is so important.